Well, stocks edging lower today as investors await the Fed's preferred inflation gauge out tomorrow. Any sign of prices reaccelerating sure to push back expectations for an interest rate cut from the Fed. But our next guest says that may not be enough to pull back stocks. He says we are in a Teflon market where bad news just doesn't stick. To break it down for us, we've got Young-Yu Ma, BMO Wealth Management U.S. Chief Investment Officer. It's good to talk to you. A Teflon market, but I have a hard time thinking that if that inflation print comes in much hotter than expected, we're not going to see a big reaction from the markets.
Hi, Akiko. It's great to be here. We actually did see two already somewhat difficult inflation prints with CPI and PPI already this month. The PCE inflation, of course, that is the Fed's preferred measure. It's true if it comes in much hotter, I think that would give the markets pause. But so far, the market's been able to shake off a lot of these inflation prints have come up so far because some of the forward-looking measures of inflation still look pretty good in terms of inflation moderating going forward. So it's still a backward-looking measure. That's important to keep in mind, and some of the forward-looking measures still look favorable.
When you talk about the market really being able to shake off some of these disappointing or hotter than expected inflation print, other disappointing data, is it more about the sort of tech trade, this huge enthusiasm around AI overshadowing that? Or, I mean, how do you make sense of the kind of reaction that we've been seeing in the market? Or is it about just this bumpy road on the road to a rate cut largely being baked in already?
I think it's a little bit of both. The market still is expecting rate cuts, even if they are pushed out, to happen later this year and probably into next year as well. But it's also a lot of enthusiasm about AI and just productivity in general. The technological improvements and the prospect for companies being able to improve productivity, improve their profit margins. A lot of people are thinking there could be a replay of the mid-1990s where we had strong productivity growth, where we had relatively low inflation, and we had market gains for several years in a row. So I think that's right now the combination of that's allowing the market to shake off some of these near-term challenges that have arisen, both inflation challenges, the Fed pushing out rate cuts, geopolitical concerns. Of course, the market's ability to do this is not unlimited, but so far it has proven quite resilient and able to shake off a lot of these concerns and really focus on some of the optimistic areas that things could play out over the next year or so.
On that optimism, you've been in the soft landing camp for some time now. As you look ahead to the second half of the year, how are you shaking up that portfolio? Do you stay the course with this expectation that there could be a rate cut come June, maybe a little later? Or is now the time to add some exposure to other areas?
Well, now's the time to certainly think about adding exposure. If people have been in their portfolios relatively cautious, we know a lot of investors have done that because they've been concerned about the prospect of a recession happening at any moment, right? The recession has been expected for quite some time and kept being pushed out. And we've been talking about a soft landing for over 14 months now. And we do think that investors that might be underinvested should certainly think about adding to the equity markets here. But we are optimistic about the second half of the year. We think the prospect for improved productivity, growth, adding to profit margins, adding to gains in the market, along with some reacceleration of corporate spending and also stability in consumer spending. We think there's enough in the mix here that even if we just get a few rate cuts this year by the Fed, that's going to provide a pretty healthy environment for risk-taking this year.
So how are you advising clients? Where do they increase exposure?
Well, the areas we like most, we think U.S. equities are still a good place to be. We don't think that valuation is something that is extreme to the point where people should be avoiding U.S. equities. We like technology in terms of sectors. We like biotech. We've been very positive on U.S. infrastructure for quite some time now, and we think that still has a long runway ahead of it. But we're also looking internationally. We've continued to like Japanese equities for some time because of the structural changes that are taking place in Japan that we think will have also provide years of runway and a tailwind for the equity markets in Japan. So there are different areas that we think provide a favorable risk reward here that we're trying to lean into a bit.
We've heard about that Japan trade for some time now. We saw the Nikkei break its record last week. mean, how much higher do you think things can go there, given the economic fundamentals, while, understanding why we are seeing so much optimism around changes in corporate governance there?
Yeah, it's important to think about some of the softness we've seen recently in Japanese economic data. We did have 2 negative quarters in a row of GDP prints, and we'll probably have a soft GDP number, growth number this coming quarter in Japan as well. But really, a lot of that is in the rearview mirror. We think some of the changes taking place, that we're seeing signs of improved wage growth that looks like it should add to consumer spending in Japan. A lot of the Japanese companies that drive the major indices are global companies, so really exposed to more to global markets than Japanese markets. But really, if you look at the main prospect, it is that improvement in shareholder friendliness, corporate governance, returning capital to shareholders. Japanese companies are sitting on a tremendous amount of cash that gives them a lot of leeway to improve returns to shareholders and redistribute capital to shareholders in terms of dividends and buybacks. And we think that is a long way to go still.
Young-Yu Ma, BMO Wealth Management U.S. Chief Investment Officer. Good to talk to you today. Appreciate the time.
Thanks, Akiko.